Hello, I'm Peter Towers, Managing Director of ESS BIZTOOLS. This webinar is going to explore delivering scaling up services by accountants, bookkeepers, and business advisors. So welcome. Scaling up, why getting the foundations right is critical. Incidentally, the foundations are critical in any type of business, but in particular, a business that aspires to scale up. There's thousands of ambitious business operators around Australia who dream of scaling up, of growing from a small operation into a thriving, sustainable enterprise. It does occur, but it doesn't occur by accident. It has to be planned, there has to be foundations, there has to be systems introduced. But let's look at a hard truth before we get carried away with scaling up a business for a client. Too many businesses fail to reach their goals, not because they got a lack of vision, but because the foundations for success were not properly built. They were too busy doing something else, never got around to doing it. Professional accountants and bookkeepers and business advisors are uniquely positioned to guide SMEs through this critical phase. The timing is everything. Perhaps an extra week in getting ready can become very beneficial. Most SMEs know they need systems in place. They need foundations. And it's understood by their team members also. But delay action until it is too late. They haven't got the system implemented for opening accounts with suppliers, for argument's sake. And they assume that they're going to be granted 30-day credit. And that's what they put in their cash flow forecast. But when they go to open those accounts, they may find, and indeed a significant number are finding at present, that those suppliers are wanting cash with order because they're aware of the business failure rates and the problems that many SMEs are having. So they're taking precautions. They're asking for cash with the order. But what does that do to that business's cash flow forecast? They assumed they had 30 days in which to pay their suppliers. And they'll survive for a few months normally. But by about 6 months' time, which is what the MYOB review conducted in March 2024 discovered. Because what caught up with them was taxation obligations. So this is where you can help them by stepping in with strategies that make a difference before it's too late, to give some guidance, to make sure they have thought through some of the problems, that they have taken an extra week or two to set everything up properly. They haven't rushed into it. And they've really entered into agreements with suppliers as to what the price is going to be and what the payment terms will be. So what are the key foundations on which scaling up is anchored? Supplier negotiations I've already jumped ahead and talked about because it's a very important area, and it was a key observation made by the MYOB CEO in his letter that was published in the Financial Review, March 2024, looking at the results of a survey that MYOB had conducted on 1,000 of their clients, with a particular emphasis on the ones who had commenced business in the last year or so. And it's very important that these pricing and payment terms are, as far as possible, decided between your client and the supplier and confirmed in writing. And then these are the figures that are utilised within the budgets and cash flow forecasts. Let's look at another one, the customer credit systems. Credit should not be extended without a formal system. One of the observations that MYOB made is that a lot of people starting business assumed that everyone would pay them within 30 days. Well, unfortunately, that's not the scene in Australia. We have very high debtors days. In fact, 4 years ago, we received a very dubious international award where Australia was judged out of about 180 countries as having the longest debtors days outstanding in the world. Not very good, is it? Now, since then, there's been moves by the federal government to tighten up on payments by government departments. And there's been some legislation introduced which had some further amendments a year ago, whereby basically there's been yet another government agency created to monitor the big end of town payments to small businesses. And the big end of town was defined as businesses with turnovers in excess of $100 million per annum. And if they don't pay, they're going to be named, and the government assumes shamed. Seems to be a lot of paperwork involved in getting that process. But Australia had that award, and I haven't seen anything that would convince me that we probably still don't hold that title. So let's look at the credit limits, the terms of trade, clear identification of the due date for payment on a tax invoice. This is very important to get your clients into the habit of making sure that their team knows that if the client is being offered terms of 30 days, that the invoice has the due date for payment on it. And then 3 or 4 days prior to that date, someone in the office should ring them and remind the customer that payment's due in 4 days' time. In that way, the business is probably doing about as good as it can to try to ensure that everyone's paying on time. It's important that there's an understanding of the role of the Personal Property Securities Register also, because there's a reason that your clients probably should be registering some of their customers onto that register to protect against liquidators claiming priority arrangements and priority payments from some people. So you need to have a discussion with your clients about that. And the cash flow forecast should reflect the realistic debtors days outstanding, which I don't think is exactly 30 days. Now, for a new business, it's difficult to say, but probably around 40 days, or even do the exercises at 50 days and see if the business stacks up. Because I've come across businesses with debtors days outstanding of 102 days. And they hadn't calculated that. They didn't know how to calculate it. And their accountant hadn't told them about it. I had a discussion with that accountant some time after that, and he said to me that it wasn't part of his brief to worry about items in the balance sheet. He hadn't calculated it, and he hadn't made any reference of the growing amount owed to the business in his report back to the client. He was primarily there to prepare the taxation return. I don't think that was the correct answer, but that's the answer that was given to me, which I then conveyed to the client. because I don't think it was good enough. And another big problem is having a plan for the payments to the tax office. During the COVID period, the tax office was very lenient about payments. I'm sure they were told that by the government. I don't think they volunteered that, but the government of the day told them to back off in taking action against SMEs. Well, I'm certain they haven't received any such instructions by the current federal government, who give every indication that they need lots of money because there's been lots of promises made. So the tax office can be very difficult to deal with now if your client falls behind on their tax obligations, because this can cripple the business, because the tax office will take action. So you can assist your clients by making sure they understand when these payments are going to be made. The PAYG, GST, superannuation, and the tax deducted from team members' salaries, so that those payments are made 3 monthly or 6 monthly. So setting the foundations are vital for scaling up. It all starts with understanding the business systems. In my experience, as both originally an employee in a chartered accountancy firm, undertaking some audit work, taxation work, company secretarial work, and then later on as the senior partner of an accounting firm. But in between, I did a 10-year period in a public company, and I was the chief financial officer, company secretary. So I've seen both sides of the ledger, if you like. And my observation was that in the public company, I knew a lot more about how that business operated and where everything was located, where the title deeds were, where everything was appropriately filed away, who had authority to do what. Whereas in a lot of the businesses we advised as accountants, and they obviously were SMEs, we never got that close to the clients. We obviously saw the annual accounts and made some adjustments to them, then prepared the tax return. There was very little interaction at other times during the year. Never really understood their risks and their risk analysis, never understood their internal control systems, didn't really inquire too much about debtors and debtors' days outstanding, although we did do that calculation and made a note of it in our report. So one of the crucial things is to understand how this business operates. What are the internal control processes? Who's got authority to place orders? Who's got authority to make payments? Who's got authority to hire people to work for the business or hire subcontractors? Who authorises payments? Jot that down so that your team can refer to it. Prepare a report to your client if you notice any gaps in the overall system so that they can be fixed. And that will give you a far better idea of what this business looks like. So the overall strategy, I think, can be best summarized as you need to understand your clients. 1 inch wide, but a mile deep. You need to really understand so that you can be that virtual chief financial officer. And to do that role, you need to know things. You can't avoid that. And obviously that review is going to identify any weaknesses in the internal control system that you would then want to make sure got fixed. The business plan. This is the essential document that all businesses need. not just ones that are aspiring to scale up, but all businesses. But I don't agree with the concept that an accountant gets a brief to prepare a business plan and they indicate a price of $3,000 or $4,000 and go off and sit in your own office and prepare a business plan for your client. Maybe very similar to a business plan you prepared for another client. That's not the approach. One of the key things is to get input from a wide range of people, the leadership team within the business, so that they can analyse your activities. So there needs to be an alignment of goals, of strategies, of business processes, of key performance indicators and business metrics, so that the plan means something, that it can be utilised to guide the business as you move forward. The 52-week business enhancement system is a key package that's really needed in SMEs. It already exists in most larger companies because the internal accountants are monitoring what does happen daily. And a daily summary report normally goes round to the leadership team members. This is how we are going in business. This is what happened yesterday. This was a key problem that occurred yesterday. This is how we got to fix it. So a daily briefing is very important. Then we go to the weekly performance and profitability report on each individual business operation. If performance is not in line with expectations, you need to then find the reason for the variation within a few days so that it can be fixed, so that that problem doesn't continue to affect the business for months and months. And it could do so if that problem is not found and fixed. Now, this is a key part of the accounting function in larger companies. I found that what larger businesses do is break down into smaller units, a retail shop on its own, even though the group might have 250 retail shops, they're all treated separate as separate profit centres. They're able to be analysed, not all consolidated together, so that if there are problems, they're immediately identifiable. And that's where the weekly performance report comes in. Managers running business units can't recall in 3 or 4 months or 12 months' time what happened today or this week. You need to get that reckoning prepared very quickly within that follow-on week. So within 3 or 4 days of the end of the week, you not only have the result, we traded at a profit of $10,000. We achieved our gross profit target, which was 38%. Or alternatively, we thought we would make 38%. We only made 22%, and we've investigated and found what the problem was. And it could have been as simple as the stock take wasn't properly conducted, and we're going to do a new check one next week and follow it through. I knew of a business, a very large retail butcher shop business in Sydney that had over 250 retail butcher shops that had a system whereby they calculated their weekly performance reports and profitability reports. And if the shop did not achieve their target, whatever it happened to be, 38%, 32%, whatever, a relief manager turned up to run the shop for the next week. The original manager was transferred to somewhere else to do some research work or whatever. If at the end of the second week, when the results were determined, the shop had returned to the percentage target that the company had, 38%, the original manager then went back in. Now, if at the end of the third week, in effect, the result was nowhere near the targeted, that gentleman no longer had a job. Now, I'm not advocating you introduce that system with your clients, but I'm outlining it to indicate to you what some businesses were doing. And in the company that I was with, we had something similar operating, that there was an accounting, and it was based on having that financial report prepared. Think about what happens with your clients at present if they're only receiving the annual set of financial accounts. It's too late then to go back and do that type of manipulation to get the things right. Then a monthly review at the end of the month is very important. A company that's aspiring to scale up, I think, really needs regular, accurate financial accounts, because a scaling up company is always looking for an opportunity. I've found an opportunity to raise some capital, issue some additional shares, or if they've got assets they can secure, borrow some extra money because they need it for a new research and development project. But there could be someone that the bank managers introduce the CEO to that's expressed an interest in looking to invest in the company. The company, your client, might be out there thinking about attracting some investors. If someone shows an interest, they can't reply, oh, well, we'll get some financials prepared and we'll get a summary done and we better update our business plan. And all that takes 5, 6 months. That potential investor is no longer around. He's found somewhere else to invest. So having the financial accounts up to date all the time is very important, I think, for all businesses, but most particularly for anyone that's wanting to scale up. Now, another important role in getting the monthly financial accounts compared to the budgets is to ensure that there's then a reconciliation with the results on the weeklies. Of course, we really want the leadership team to rely on the information that's been given to them on the weekly results. And the weekly results are going to be combined with actual data that's known. We know the sales, we know the wages, things like rent, but there'll be some costs that are not particularly known there. So they're extracts out of the budget that are used to get the figures right. So you need a reconciliation at the end of the month to make sure that the weekly estimates are 98% accurate, preferably over 100, but let's say 98% accurate, so that the leadership team's got some confidence that when you tell them that the target was 38%, we've only achieved 22%, so you need to make this a high priority. You need them to then react, not to say, oh, are you sure you haven't made a mistake? Oh, we'll have a look at this next week. Next week might be exactly the same. So they're now down another week in their performance. It's very important. I was a public company chief financial officer, as I said. As I walked into the public company board meetings every month, I'd normally be walking with the CEO and he'd just make an aside comment to me and say, oh, Pete, how did you go? Did you reconcile the monthly accounts with the weekly estimates all right? I said, yes, I've sent you a report on that. And we reconciled and we were happy. Okay, thanks. So when he was talking to in the directors meeting, he would say that, because the directors knew that he was running the business on the weekly results. The monthly accounts, as far as he was concerned, were there to prove that the estimates that we'd utilised to guide him and the other leadership team members and our various area managers was accurate. How can your client choose this type of information? Some of them are running quite a number of businesses. Some of them are growing quite large. And we are spearheading this whole conversation today on people who are planning to scale up. You understand the direction we're taking. Now, the 52-week business enhancement system also needs a rhythm of meetings. But I probably said that a little bit incorrectly, because every business needs a rhythm of meetings. But the whole process that we've got daily, weekly, monthly also fits in with making sure there is a rhythm of meetings. Now, I'm addressing these comments now to the leadership team members. But there are also other meetings that take place within a business, within individual teams or specialities. The daily huddle is an important meeting. 5 to 10 minutes at a set time. People can't make it. Lots of businesses have rules. They have to phone in. And basically it is, did anything go wrong yesterday that we need to know about? Was there any major announcements by the government or the banks or from our overseas customers that we need to be aware of? So that's that urgency. Did something happen that we need to be aware of, that perhaps we need to now go away and read all the documents, read what the media's had to say about a particular issue and reconvene at lunchtime? That type of thing can follow on. The weekly meeting is to review the week's performance that's just passed. How did it go? What was the results? What was the gross profit percentage? What was the average sale? What was the labour to turnover? How do all these figures compare to the previous trends in this business? And if the weekly results don't conform with the budget estimate, there needs to be follow-up action, as I've just referred to make sure that that problem doesn't continue to cause problems to the business. And the monthly review meeting. Now, this is a meeting that could be a formal board of directors meeting. A lot of businesses have leadership team meetings with the CEO, but then the overall results and summaries and comments will be passed on to a board of directors. And many SMEs have other series of meetings whereby they're looking at the results and analysing what is shown. Now, one of the key functions of this analysis, which will be based on a financial report that you have prepared as the virtual Chief Financial Officer, is looking at the projections in cash flow. There may be some hiccups that are appearing on the radar in 6 or 7 or 8 months' time. What could be causing that? What strategies need to be implemented now to overcome those problems? And this is all part of this cash flow analysis, which is a very important role to be looking at with your clients on a month-by-month basis. All sorts of things can go wrong once the budget's been prepared and agreed to, and the cash flow forecast. And a lot of that can be caused by events that are out of your client's control. Not all, but some of them could be. If your client is reliant on supplies coming from overseas markets, the unfortunate wars that are taking place in the Middle East, in Europe, in India and Pakistan, just to name a few. And there are other events happening in other parts of the world that can cause shipping companies to change their routes and their frequency of voyages coming to Australia. And this can mean that your client needs to make a decision as to what level of inventory they need for their raw materials. They may have been relying on having 6 weeks supply on hand to meet their requirements, but perhaps they've decided that the figure needs to be increased to 12 weeks. And what's the effect of that going to be on the cash flow? Because I'm sure that supplier of that materials will still want to get paid when the delivery is made. So it's sitting down and analysing these trends, but your client might also be involved in a capital expenditure project. And a lot of capital expenditure projects get off the rails, don't they? Especially if they're government projects, but it also happens in private enterprise. So what's the likely effects of that going to be on the cash flow balance? Or it could be a research and development project. And this is a scaling up company we're looking at. And research and development, people can get carried away with at times. They do their original estimates and they say, oh yeah, we think we can do this research that we need for $250,000 over a 2-year period, and they start working on it. And they might find some very capable people who are able to come in to undertake the key parts of that research project, but they're only available for the next 6 months. So instead of having it spread over a 2-year period, and I've seen this happen, that team of people are brought together and are there for six months, but that money's got to be available there and then to pay them. So what's that do to the cash flow forecast? So this is all part of the cash flow analysis and having an awareness to sit down and talk with whoever's controlling the research and development project, whoever's looking after the development of the commercialization of some part of the products or services that this company that plans to scale up is involved with. Because scaling up means that there's a significant increase in activity over a very short period. The company goes from a 1 million turnover to a 10 million turnover in 1 to 2 years. And in fact, in America, some of them would do that in a couple of months as they scale up. What's the effect on the cash flow? And what should we be looking at? Now, your role, as I see it, is to make sure you can communicate in non-technical jargon to the leadership team so that they clearly understand what all this means. Financial management's not their normal activity. So you need to be able to be the storyteller to acquaint them with what's happening and what the suggested remedies are for that. Because no use just outlining the problem, you then need to be able to identify how it can be fixed. Research and development, as I say there in that slide, the vast majority of people scaling up are involved in research and development activities. That gives them the ability to be able to scale up their business. So there's need for significant records to be kept on research and development. Now, I don't think they're frightening, although some of my professional colleagues have expressed that to me at times. I don't think that's the problem. There is records to be kept, and you need to be able to communicate to your clients the need that these records are accurate, they're properly maintained, people are signing off on their timesheets or their time recording devices, and the reports that are required on various experiments that are conducted are properly completed and documented. Now, within the ESS BIZTOOLS system, we have prepared a whole series of forms to enable the record keeping that the tax office and Oz industry require. In fact, there's 46 of those forms in our system, but don't get too concerned. I don't think any one client would ever use 46, but there's a possibility if you had 10 to 15 clients undertaking research and development that you might use all 46 over those 10 to 15 firms, depending on their circumstances and what they're wanting to do. Some accountants have said to me, Peter, we can't give advice on research and development because I'm not an engineer or I'm not a scientist. And I said, what's that got to do with it? Oh, well, we got to help the clients do the research, haven't we? I say no. The client is responsible for the research activities. It's up to the client. If they need assistance, they need to go and hire experts, and there's people out there who can assist them. Or they can negotiate a deal with a university for university people to be available to assist in the research project. But it's not your role as an accountant to sit there with a test tube and a thermometer and everything else that goes on in undertaking research. And some of these research projects can take a long time, and they can be involved on a daily basis. And there might be 2 or 3 people working in it. In fact, in one of the larger ones I've been involved in, they had about 30 people working in the research every day. Not all day on the project, but part of every day. So there's a need to record their times, who they are, what time they started, what time they finished, what did they do. In our system, we've got some suggestions on identifying work codes so that you can save the handwriting. They can put a code number in for what they may have done. And it's important that those sheets are signed, because it might be 3 or 4 years' time before there's a knock on the door and there's someone there from Oz Industry or the tax office wanting to check the records on research and development projects that might have occurred 3 or 4 years earlier. Now, I've noticed over the years that a lot of the people actually undertaking research and development activities in various businesses are people from overseas countries. They're here on a bit of a break, a gap year, sometimes a gap year after finishing university before they go out and work, and they're good people to work on R&D projects. But you've got to remember, by the time that tax office guy's there wanting to talk to you, that person may be back in Ireland or maybe back in Germany or France or United States, Argentina. They can be anywhere. And you're not going to be able to potentially find them, and they will have forgotten what they did. So it's vital that what they've worked on that day is summarised and signed for. And that's what's spelled out in our system. But you can perform a great role for them, and I've decided I needed to give it a title, so I'm calling it an internal auditor role, because the forms are all there. You just got to make sure the client's filling them in and reconciling them. And on a large project, I think there's at least a need for a monthly review, or perhaps 3 monthly, but don't let it go for 12 months. R&D is very important. Now, what all these discussions about cash flow and research and development and inventory levels that might vary are all coming back to looking at what the cash position is going to be. And to overcome the cash position, the key word is funding. Where's the funding going to come from? Now, it could come from the current owners who have got spare cash resources. So if a couple of $100,000 needed, they can put it in. But it might be $1 million that's needed, or $2 million. So funding is an issue, especially for a scaling up company. I think they're in a continual awareness of needing money, needed to be able to raise money. So you need an awareness of the opportunities to raise capital for SMEs. The first one is the early stage innovation company. This has been in operation for about 8 years, and it's ideal for a young company, not young executives, a young company who are proposing to undertake innovative activities, and they're normally centred on research and development. Now, there's special benefits for the investors, not for the company. The company gets the cash from the investor. But the government under Malcolm Turnbull was very aware, as Mr. Turnbull was, of the problems that young companies have in raising capital. So they introduced a carrot, the only one that I've ever been able to identify that the government in Australia has offered. So for eligible companies, which normally are under 3 years of age, but there's some circumstances which I won't go into now, but you can find that out in our material. companies up to 6 years of age can be eligible. The turnover is under $200,000. So these are young companies, not including any grant from a special government grant. And that's a grant to help with their development. And expenditure under $1 million in both cases in the previous 12 months. So they're very small companies. And the investors receive a benefit. In fact, the benefit is 20% of their investment comes off their tax bill. So if the shareholders invested $50,000, 20% is $10,000, comes off their tax bill. If they've invested $1 million, they get $200,000, and that's the maximum. The maximum tax offset's $200,000. But the big benefit is if they hold the shares for longer than in the company that they received as part of this status determination that the company qualifies to be an early stage innovation company. Incidentally, they're not incorporated as an early stage innovation company. They're just a normal company, normal private company that can go through this process to then be deemed by the tax office and Oz Industry to be an early stage innovation company. So they can accept this investment from shareholders who then receive this benefit. So the second benefit is that they hold the shares for longer than 12 months and less than 10 years. They pay no capital gains tax when they sell those shares that were issued as part of this status process. And that can be very attractive to investors. Crowdsource funding, equity raising, any type of business run by a private company or an unlisted public company with an international turnover of less than $25 million, with international gross assets less than $25 million, not listed on a stock exchange. A couple of other very minor activities, only quite a very small number, but that's the prime type of companies. Now, they've got to work through a Australian Security Investment Commission appointed crowdsource funding intermediary, but they can raise up to $5 million from the public going through the processes. And then we got Section 708 of the Corporations Act. For any of you who are a bit older, you know that 708 started, I think, in 2001. But prior to that, there were state acts all around Australia that there was something similar to what is now Section 708. It's got a few restrictions, but $2 million can be raised, but from a maximum of 20 investors. Now, none of this will happen unless the company has prepared documents which highlight the vision, what they're wanting to achieve, together with a business plan, the projected accounting reports, the valuation, and that there is an enthusiastic group of directors and leadership team people, that there's a willingness to accept money from external investors and understand that they're going to be allocated shares, and one or two of them may want to join the board of directors. That may be part of the bargaining that goes on. This is how companies grow, and most definitely a lot of scaling up companies go down this path. So you need to make sure you've thought about it and talk to your client about it. So where do you start on the delivery of services for scaling up business? I think we can help you. Hopefully you can say today's the start of it, or whenever you watch this video. So I know that many of you will watch this at a time more suitable, and we'll be sending the videos around to people that have expressed interest. We can assist you with a wide range of activities because we've developed product packages for everything that we've mentioned in this presentation, and a lot of other product packages as well. Because our vision is to supply the services that SMEs need, your clients need, and to make you the conduit to be able to supply those services. So I invite you to visit our website, www.essbiztools.com.au, to view the wide range of products that will assist you to deliver a wide range of services for those SME clients, especially those ones who want to scale up. And if you'd like to have a 40-minute complimentary Zoom meeting with me, where I'll go through how ESS BIZTOOLS could fit into your organisation, what the processes are, what our training programs are about, and how they operate, we can discuss the whole thing. Just send me an email, thanks. peter@essbiztools.com.au. And my marketing manager will set up a time for you that we can have the conversation. Now, it could be you on your own, could be your partners or your directors, or it could be your whole firm if you wish. I've had some of these meetings with 50 or 60 people, I'm told, in the room. They wanted the team to hear what we were going to discuss. That's up to you. If you've got any questions on any of the matters that we have discussed in this presentation, please send me an email, peter@essbiztools.com.au. And I look forward to hearing from you. Stay safe and have a great day. Goodbye. And I look forward to hearing any questions you've had of any aspect of what we've discussed in this webinar today. Thank you.